Many thanks, Victor, for joining us on the program. Now, let me start by asking you.
Thanks for having me.
All right, let me start by asking you if you expected the rate cut from the CBN MPC meeting or by as much as 100 basis points or not.
Well, I think, like you said in your opening remark, it was a largely unexpected move, and it was basically on the back of the fact that a lot of analysts did not see that the Apex Bank was going to cut that significantly. But I think what the Apex Bank did with that, reduction is a strong signal and a strong posture to indicate that it is more concerned about reflating the economy and, creating the right environment for output growth to thrive. Recall that our economy has been essentially on the mend. When we started 2020, we had a 1.87% GDP growth in Q1, but of course the whole COVID-19 pandemic with its attendant impact saw a 6.1% decline in Q2. So, for the Apex Bank, the core mandate is price stability with regards to inflation and exchange rates. But of course, if you pass through the communique, you would see that the continuous rise in inflation has essentially been on the back of structural issues, not necessarily issues that have to do with monetary policy. So, and that's the reason we're seeing, the Apex Bank addressing that with what you might describe as unconventional or development finance tools. Because as long as those bottlenecks are addressed, then the inflation situation can improve. So the 100 basis point cut wasn't expected. That was not what a lot of analysts had, hoped for. But again, it's just a strong now from the committee that output growth right now is on the front burner.
Now, one thing the committee referenced was the uptrend in consumer prices, but then it also noted that it's not as a result of money factors. Do you agree with their views?
Absolutely. Inflation in Nigeria is typically as a result of supply disruptions, which largely then leads to cost. So our inflation is likely cost push. So a lot of the inefficiencies, a lot of the bottlenecks, a lot of the supply side disruptions are the factors that really creates this inflationary trend. And monetary policy wouldn't necessarily address how to essentially address that. Is to use policies that would detangle those bottlenecks, that will make this move more smoothly, ensure that there are little or no disruptions, that would enhance the supply side, and we see some sort of moderation. So I agree that these are not monetary related factors that have led to the uptrend we've seen in inflation, and using monetary factors to address them would not achieve much. And that's the reason the Apex Committee decided to go the path that it did.
Now, how is this decision being perceived across the investing community? Of course, is it seen as a plus for Naira denominated assets or otherwise?
Well, if you look at the straight impact at yesterday's auction, particularly the bond auction, we've seen yields decline. That is expected, really. The equity markets, we saw market up about a third yesterday, not necessarily directly linked to that issue. But generally, I think that what that has done is to further push yields downwards. So that's the impact that's seen. Again, most analysts, investing did not expect that we'll see that quarter, not even as much as 100 basis points.
But do you expect local investors to start considering the Eurobond markets, given the similar level of yields in both local Naira denominated and Eurobond?
I think that has actually been a trend before now. The yield, the Eurobonds have essentially been around almost the level with the local bonds, and then if you consider the current situation, it makes the Eurobonds a bit more attractive. So that has been a trend for now, and I expect that is even likely to continue.
Just a few weeks ago, Victor, the CBN also announced a reduction in interest rates and savings deposits from 30% of MPR to 10% of MPR. What effect would this benchmark rate have on savings that's going forward?
It'll just be direct, really. Basically, is that since rate basically dropped about just slightly over 1% for the average saver, it basically means that you're earning less. But from the bank's perspective, it will basically speak to a reduction of their cost, particularly for those banks that have a huge mix of savings and current account deposits. They are going to benefit quite significantly, and that should also sort of boost their net interest margin. But again, consider the fact that, the yield on assets is also trending downwards. Maybe that could just offset it and we could have zero-sum gain. But generally, it just basically implies that, savings or the earnings of savings will also even reduce further.
Do you see this as a step, or do you see this step rather as a strategic decision of government to brace up for return to the Eurobond markets next year?
Not necessarily. I think that, what the Apex Bank has done is to prioritize output growth to ensure that Q4 or Q1 in 2021 would essentially return to some semblance of growth. Remember what the bank is doing now. We've seen about 3.5 trillion worth of direct tensions in various sectors and various aspects of the economy. The idea is to try and stave off or ward off the potential impact of the COVID-19 on the economy, and also the slowing down of the global economy as well. So what the Bank is essentially doing is to prioritize output growth, and I think that it's a step in the right direction at this time.
Now, just before I let you go, Victor, tell us what are the fiscal measures you expect to complement this rate cut decisions in order to further stimulate economic growth?
I think on the fiscal side, things are significantly changed, particularly from a revenue standpoint. And that's the reason you're seeing the Bank step up to do that it's doing. The truth of the matter is that the sort of collapse that we've seen in crude oil prices, yes, we've seen some recovery over the last couple of months, but you certainly cannot compare the sort of revenue we are seeing from that front to what we were seeing last year. Again, as a result of the significant economic downturn, obviously it will have negative impact on tax revenues and all of that. So on the fiscal side, there's a strong revenue challenge. It significantly limits, what the fiscal authorities can do, at least for now. Nevertheless, I think the idea would be to align, coordinate with monetary authorities to ensure that there is robust support for the real sectors in the economy. I have then juxtapose that with the idea that the fiscal authorities also want to earn more in terms of revenue, particularly from taxes and all of that. So do you want to tax more at this time to earn more, such that businesses and corporates suffer? This is not a simple decision, really, and challenges on the fiscal side will be with us at least for another 6 to 9 months thereabouts.
And our portfolio management at Commercial Partners Asset Management, Victor Louis, thanks for sharing your time with us.
Thank you.